You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, Federal Reserve has created turmoil in the banking sector, and turmoil inevitably is going to spread to the broader economy. We just had the second largest bank failure in the United States history. I would just qualify that by saying the second biggest bank failure where the government actually took over and auctioned off the bank. We've had other larger failures where the government just bailed it out, but everybody wants to forget about that. And with us now is James F. Locke, financial expert at Poole Locke. And you find him at Poole, POOLE, that's two E's where you wouldn't have expected them, .com. And hey, if you got a question for James or myself, just shoot us an email, kl@kerrylutz.com. And James, so banking collapse, banking failure, banking turmoil, what does that do to you as an investor trying to line up a retirement, trying to get to the promised land, and all these obstacles are falling in your path?
Yeah, the banking failures it's a difficult one because you and I sit here, when you're in the industry, you look at these things, you're diving into them a little deeper. And we see these as real risks, right? A lot of times people that are just, let's just say, walking the street with their 401k say, the bank isn't going to fail or the government's there behind it. And yes, they are to a degree. And that's actually very, very important. But I don't think people realize exactly how dangerous it is when you start taking these banks, especially such as big, as what we've had, and consolidating them. Now, every time there's a problem in the future, it's exemplified that much more, right? It becomes worse and worse. And like you said, this is, banks fail more than we think, right? Or at least they have to get bailed out by each other. So something needs to change in order to help everyday people understand that, we are living in a dangerous time.
Yeah, that we are. Very dangerous to your wealth. This is all predictable. The legislation that was passed to deal with these future bank failures back after the last financial collapse was Dodd-Frank. And now they've basically thrown Dodd-Frank to the wind because Dodd-Frank said that there would be bail-ins and that the depositors would be responsible for bailing out the bank, not the federal government. Now, Dodd-Frank was totally idiotically conceived because, look, when you got a banking system where all the banks are insolvent, the only thing that keeps everybody running to the bank or going on their app to transfer the money out is the fact that government is backstopping it,
standing behind it,
to allow a widespread bank panic. So, Yellen, she initially stuck to Dodd-Frank, and that lasted for 5 minutes when they realized that, hey, if we don't guarantee all bank deposits, every bank, we're going to have a massive collapse on our hands, a massive banking failure, and nothing is going to stop it, and all the banks will go down. So, but the question is, can they really stop what's happening now?
Yeah.
How far will they go?
There's multiple sides to this too, since you just talked about Yellen. Just yesterday she came out and said, we're only good on debt until June 1st. June 1st. You know what I mean? Like, that's insane. So the debt ceiling, which, knock on wood, the government's going to, pass something to raise the debt ceiling, and we have to get, out from under ourselves in that sense. Mm-hmm. It's not a Republican Democrat thing. I mean, it's going to have to happen. Otherwise, you're going to, if we got, I mean, heck, back the last time we had, a serious credit problem and the U.S. credit rating was dropped, when you kind of do the math, that downgrade cost the Treasury, they said, $1.3 billion, because we got downgraded. Like, it's like cutting off your nose to spite your face a little bit here. It just doesn't make any sense to be shooting yourself in the foot. So we got a lot of factors at play here. You got the Federal Reserve, which, to be clear, this is all their fault, right? Now, I'm saying it's their fault because they're the only one in the position to do anything. And I'll asterisk that because Congress can do a lot, but they just don't. But the Federal Reserve has one bullet in its gun, and that's raising interest rate, and it's going to keep firing it. And, they pushed it up so much that we've seen, 3 banks fail. And that's really the bottom line. Now, the banks clearly could have had better leadership, even better oversight, loosely speaking. But at the end of the day, this was caused by the Federal Reserve's unprecedented ramming up of interest rates so fast that, the banking world couldn't handle it. And in fact, just today, you now have lawmakers coming out and saying, hey, Fed shouldn't raise rates tomorrow, right? Which, if I'm a betting man, I love it. They're raising rates tomorrow. It's going up a quarter point.
Baked in the cake.
It's baked in. Yeah, I would be shocked if they didn't raise rates. If they didn't raise rates, it means that there's actually some problem, right? And if they raise rates more than 0.25%, all hell's going to break loose to the downside, and it'll settle eventually. But essentially, they're trying to tell the Fed, hey, like, this is what it sounds like. It sounds like the Congress is okay with inflation and wants to avoid a recession at all possible costs, right?
Yeah, well, that's why the Fed runs the money supply. At least in theory, they did.
Right.
But, whether that's the case or not, we could debate that. It's supposed to be removed from all politics, but we know about that. But so quarter points baked in, but they'll do the quarter point because there's no risk to it, basically.
Yep.
And when they got to start cutting, they got that much more to work with, right?
Yeah. Let's hope that the language, they're going to be very careful in the language that they speak. And it's probably going to, I would imagine it's going to be mixed in some people say, maybe we're going to slow down, but we're going to be quick to jump in if we find, numbers show that, there is, too much growth in the economy and things like that. We're still trying to cool this off.
Yeah.
And so, that I'd be surprised if they come out and be like, yep, job's done. Everything's perfect. Then that would be, the stock market would start rallying something fierce. But, they're not going to say that. That's for sure. And what's interesting is in history, if you go back and look at all the times the Fed has kind of reached their number and basically said, okay, we reached our number, we feel things are pretty good. It doesn't always mean that stocks rally, historically speaking. You don't always see that. And we've been looking for clear signs of a slowdown and easing inflation to kind of justify the end of this rate increase. But what could end up happening is the dreaded stagflation, right? So now you're going to have slower growth combined with that inflation continuing on. And Congress is okay with that because they just want to spend money, right? And that's why I say this is all Fed created.
Yeah.
But it's only because the Congress, the one who really controls everything, if they could cut spending, that would actually play a much bigger factor than Federal Reserve with their, silver bullet of interest rates.
Right. All right. Well, it's going to be interesting to see where they finally end up on this. But I think at some point, basically, the end of rate hikes are going to be there. Look, if they hadn't stuck to the transitory inflation thing,
yeah, that was a problem.
Started a year earlier, easy enough to taper off the mortgage-backed security purchases and doing a quarter 25 basis points every other month.
Right.
Would have been a gentler curve, and we'd be in the same place where we are now, but the market would have been able to adapt to it. But
that had happened slower, right? We have, we're we're all emotion here. It's all, oh my God, inflation's out of control. We need to do something. And then, all right, we got to take interest rates up unprecedented levels. And, there's pain. There's pain that's happened, and we're seeing it in the banking world. We still don't know that we're out of the woods yet.
No, I never doubt it.
Yeah.
But there will be hey, who knows? Maybe in 6 weeks, they'll have to cut rates by a whole percentage point or 1.5. If they get desperate, what else can they do?
Yep. That's the only bullet they have in their chamber, right? That's ultimately the problem. That's why I said it's more than everyone looks to the Fed to solve the problem. But if Congress could, adjust their spending, that would actually be a bigger, a bigger change to the economy, for sure.
Good
and
luck.
If the Fed does cut rates later this year, which, there's still some numbers out there saying that we're going to see rate cuts in 2023. You never know, but it's coming. It has to. This can't continue this way forever.
Not surprise. It definitely would not surprise me. Nothing surprises me at this point, James. So when we talk next month, what do you think the landscape's going to look like then?
Assuming the language comes out neutral, which I think the Fed has to kind of hedge their bet on that. And we're going to raise a quarter point. That's that's going to happen. Assuming the language comes out neutral, I have no reason to believe that the stock market can go up based on the Fed being neutral, right?
Yeah.
So it's really going to be, we're going to have to wait and see what CPI comes out. Do we continue to have inflation under control? And we're probably going to continue to bounce around in this kind of S&P range, 38 to 40, whatever, 42 or something like that, until we come out of the earnings season and all that, and see, hey, are companies actually making money? What's the strength of the dollar doing? We still have a complete lunatic over in Europe with a war, right? Like that's a unknown variable there with Putin and all that.
Forget about the lunatic here. We're talking lunatics. There's enough to go around, right?
I mean, like I said, just today, Congress is telling the Fed, what to do, and I wish the Fed would tell Congress what to do sometimes.
Yeah, well, maybe they will one day, but not today, right?
Yeah, I don't see any change in 30 days. We're going to continue to float sideways. We have to get more definitive information on what's happening with our economy, where the dollar's floating, and what's happening with interest rates, with inflation. Because if inflation continues along and continues to drop a little bit, well, then, we're going to start moving towards, maybe interest rates dropping a tiny bit.
Right.
And there being a more predictable pattern of economic growth.
All right. Well, hey, we appreciate your input here and your opinions, James, as always. And again, the site to go to is Pool Lock. That's pool with an E, lock with an E.com. And if you got a question for James, myself, shoot me an email, kl@kerrylutz.com. And James, we'll talk to you again in June.
Thanks, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.